Have you ever wondered what happens when cloud tech meets old school infrastructure? Or when clean energy gets redefined at a scale we rarely talk about? Well, today we're diving into two Nasdaq underdog plays that most big cap investors overlook, but shouldn't. Here's the kicker. One of these companies is turning most of its revenue into predictable, recurring cash, while net income jumps 70% year over year. The other is already generating more annual revenue than its market value, backed by decade-long contracts. Together, they're building the kind of fundamentals that don't just grow steadily, but can set the stage for parabolic upside when the market finally catches on. Could you spot these hidden financial opportunities before everyone else? That's exactly what we're unpacking today. On one side, we have a company quietly transforming data infrastructure. Think Amazon Web Services meets mission-critical business continuity. And on the other, a clean energy pivot that could redefine how industries fuel themselves, from aerospace to marine logistics. What would it feel like to uncover these before the crowd, to ask the right questions, before the headlines hit? Before we jump in, welcome to Kingsley Market Intelligence, your source for emerging tech, high-potential opportunities, and data-driven U.S. market insights, helping you spot the next big winner. In the next few minutes, we'll unpack both Data Storage Corporation, ticker DTST, and Stabilis Solutions, ticker SLNG. We'll see why they matter, and what could make them compelling over a multi-year horizon. If you're thinking about asymmetric risk versus reward, stick with me. This isn't just stock talk. This is industry transformation talk. Here's the deal. This isn't a quick hype piece. We're going deep, storytelling, numbers, real-world context, giving you a strategic view. I'm not just telling you what's happening, I'm explaining why it might matter to long-term investors who care about growth and optionality, more than quick trading noise. By the end, you'll understand how enterprise cloud and clean energy intersect with macro growth trends and real contracts shaping performance, today and tomorrow. Let's start with mindset, because that sets up how we interpret risk, growth, and opportunity. Investing isn't about chasing every tick up on a chart. It's about owning optionality, assets with more upside than downside over time. Remember this. Value optionality beats short-term volatility. If a company has multiple catalysts, structural demand, recurring revenue, new markets, valuation asymmetry, even if overlooked today, it might reward patience. That's what we're looking for in these two tickers. Optionality, not hype. And yes, optionality carries risk too. Managing risk is how you stay in the game long enough to win. If you've ever had nightmares about data loss, compliance penalties, or system outages, you're already thinking about why this matters. DTST provides cloud infrastructure, disaster recovery, cybersecurity, and business continuity services, essentials for serious enterprises. In a world where data outages can cost millions, that's mission critical. Here's a key pivot point. In 2024, DTST shifted its revenue mix toward recurring subscription streams instead of one-off equipment sales. By year-end, over 80% of revenue was recurring, with an annualized run rate of about $22 million. That may not sound huge compared to AWS, but for a company trading under a $50 million market cap, it's material. Imagine this. A service customers pay for month after month. Predictable revenue that investors value. DTST isn't standing still. Leadership-appointed strategic advisors relaunched their site and doubled down on hybrid acquisition and recurring revenue strategies targeting cybersecurity, telecom, and AI-adjacent services. CEO Chuck Peluso frames this transition as a platform for future acquisitions and technology enablement. Strategic language you don't hear from companies without a plan. Now the numbers. DTST's market cap sits well under $50 million. generating roughly $25 million in annual revenues. Profitability? It's happening. Net income improved approximately 70% in 2024 versus the prior year, and they ended debt-free with over $12 million in cash. That's not typical for a penny stock. Behaviorally, the market doesn't value predictability like hype. Recurring revenue companies usually trade at higher multiples, but only when noticed. Will consistent execution and recurring revenue growth erode that valuation discount? We can't predict price, but the value framework is clear. If DTST is the infrastructure safety net of the digital world, our next stock, SLNG, is the infrastructure safety net of the physical energy world. SLNG is a clean energy and logistics play centered around liquefied natural gas and turnkey fuel solutions. LNG produces fewer emissions than diesel or bunker fuel, and it's gaining traction in marine shipping, industrial power, aerospace, and distributed generation markets. SLNG delivers engineered energy solutions, from production to storage to transportation to fueling. This is full-scope logistics plus energy infrastructure. It has scaled steadily since its Nasdaq listing in 2021. In 2025, SLNG secured a 10-year LNG bunkering agreement with global marine operators at the port of Galveston. A decade-long contract in a nascent marine LNG market creates visibility into future demand, exactly what investors look for when assessing long-term optionality. They also signed a time charter for the LNG bunkering vessel Garibaldi, delivering LNG directly to ships as early as 2026. Marine bunkering LNG is strategic as emissions rules tighten. SLNG, as supplier, operator, and logistics manager, sets it apart, enabling the fuel economy of the future. Financials. SLNG's market cap is around $80 to $90 million, while trailing 12-month revenue exceeds $70 million. Profitability is mixed, some positive net income, expanded margins. But revenue variability and project timing are typical in capital-intensive energy businesses. Contracts don't hit revenue immediately. Vessels and infrastructure take time. A fully operational Galveston LNG facility, with long-term offtake, could materially uplift cash flows. Expansion into aerospace and power generation adds diversification. This is multi-year optionality. Financing and execution risks remain real. Before we wrap, which story resonated more, DTST's cloud pivot or SLNG's energy build-out? Drop a comment and tell us why. Like this video if the narrative helped, and subscribe for the next deep dive. Connecting under-the-radar opportunities. None of this is financial advice, just thoughtful analysis. Bringing it together, DTST operates in digital infrastructure, cloud, data continuity, cybersecurity. SLNG plays in the energy transition, LNG, bridging fossil fuels and lower emissions power. They represent complementary optionalities, recurring revenue versus infrastructure build-out. Most investors overlook these tickers, not for lack of story, but because they're outside the spotlight. People chase hyped stocks, while these companies build quietly, contract by contract. Walk away with this. DTST is pivoting to recurring, predictable growth. SLNG anchors long-term contracts in clean energy logistics. Both appeal to investors seeking structural optionality over short-term noise. Imagine missing an early view. That's the regret many investors talk about later. If you could hold only one, for 3 to 5 years, which would it be? And why? Patience and clarity beat FOMO. Every time. We'll see you in the next deep dive on another small cap with potential to surprise mainstream investors. Cheers to thoughtful investing.